Hello, and welcome to the Market Bull podcast. Please note, topics and stocks discussed in this podcast are not financial or investment advice. Today on the show, I spoke with Gwen Preston, the founder of the Resource Maven, which is an independent research and newsletter focused on the United States and Canadian mining small caps. Gwen talked about her interest in the resources sector and why she left her salary job to start and pursue this venture. Gwen alluded to the looming metals deficit that we're facing and the excitement she has for the next metals bull market run. Gwen also explored why the US markets have been so resilient, given that many expected a recession early this year. She also talked about where her focus is for both the short and long term in certain commodities and why she's looking at them. If you enjoyed this episode and want to make sure you don't miss another, please make sure to like and subscribe to the show. So hello, I'm Ben Kostrich, and this is the Market Bull podcast. Joining me today for our first appearance is Gwen Preston, the Resource Maven. We were just talking before. It's really her, and it's pretty much a independent small cap analysis and newsletter that's grown exponentially since it started in 2014. So welcome to the show, Gwen.
Thanks so much for having me. It's lovely to see your face.
So let's start with yourself. If people haven't encountered you before, because I'm speaking to you, I'm in Australia, you're in Canada. Naturally, these days with technology, it's easy to get information around, but I'm sure that people may not have heard of you before. So who are you as a person, and how did you get invested in developing the Resource Maven?
These are good questions these days, right? Few people have straight paths to what they end up doing. So my background's in chemistry and journalism, and when I finished that, I ended up getting a job at a newspaper that was all about global mineral exploration and development. I didn't know the first thing about the markets or mining. I'd never invested in a stock, but I spent most of the next 7 years writing, traveling the world, seeing projects, meeting people, and being a journalist, which means asking questions until you understand. And as it turned out, in that time frame, it also included the Great Financial Crisis, there was the bull market that was ongoing, the Great Financial Crisis, the second bull market in metals, and then turning into the bear market. So I also got to see some compressed cycles. It's like I got a fast forward version of the cycles that happen in metals. So it was an incredible learning experience. That's where I got my feet in. That's where I met a lot of people and learned a lot of things. In the middle of that time, I had spent a bit of time away from the newspaper as a ghostwriter for a major newsletter writer for Marin Katuza when he was still with Casey Research. So that gave me a window into the newsletter business. So then in 2014, I decided that I wanted to be more independent and more engaged in the space. As a journalist, you can't own stocks, so I hadn't done the actual investing side of it. So in 2014, I left that salaried job and went off to start my own business. And my business is the Resource Maven. So I write a couple of different newsletters under that banner, but they're all focused on metals and mining. They're predominantly looking at the higher risk exploration, development end of the spectrum. And I certainly do a fair bit of commenting and researching and trying to understand the macroeconomic picture as well, because there's no point investing in metals. Because of those cycles, there's no point investing in metals unless you're on the correct side of that cycle. So that's who I am.
And stepping away from a salary role and almost taking the punt on building the Resource Maven and creating this newsletter and almost following, what was going through your mind if I throw you back to 2014 and really just immersing yourself in what you'd say a risky decision to begin with?
I was terrified. But I will also say that I was pretty confident. And Rick Rule has this famous saying that being too early is the same as being wrong. We'll get to that in a minute. But I was pretty confident that the bear market that metals had been in since for 2012 through it ended up ending in late 2015, that it had to turn. And I wanted to be involved in that turn. I wanted to be my portfolio positioned for that turn. So I was also excited because I felt like I had the foundational knowledge and the network to see good opportunities and just to invest in the cycle. And investing in the cycle on its own can work pretty darn well. Investing in the cycle while also knowing details about how to invest in speculative, tiny junior mining stocks can work really well. So I was excited about that potential. Now, of course, we did have a bit of a run in gold and whatnot in 2016. And then things have been a little bit stop and go since then. I mean, that's my kind way of saying it.
Mhm.
Because of all kinds of crazy things that have gone on in the markets. But I'm still excited, albeit with a huge layer of sort of when is this going to happen on top of it. Because I do still think that we are looking ahead to a major bull market in metals. Um, Gold will be involved in that, but the deficits that are ahead for the major metals that we use to build things and move energy are dramatic. And I think there's a good set of reasons why people haven't invested in that
Mm.
for the last decade. But I think those reasons are going to slash will have to change because we just we can't not have these metals. So I am still excited. Maybe I feel like they say patience is a virtue. I'm pretty much a saint at this point, waiting
Mm.
for the market. But there's been good runs along the way because good discoveries can give you some great returns along the way. So that's kept things exciting. And I just love it. I love the geology. I love the exploration. I love that it's all around the world. I love trying to figure out the economic side of it. So yeah, it's been a good ride.
And I mean, has that been combining naturally your previous experience in journalism of actually researching and understanding it? Because I mean, naturally, you're equipped with certain skills as a journalist to research and understand what you're presenting to the masses in a way. And I mean, going through that and just immersing yourself in learning about these metals and really the overlooming picture. I mean, I can happily say now, it's similar with you. We're hitting this inflection point where there has been an underwhelming investment in mines and metals, and we're starting to see this pitchfork in the road where it's turning. It's just a matter of where you position to capitalize. So as you've gone through this naturally, I mean, there's clearly been metals that have jumped out to you or certain periods in time that you've really capitalized on. I mean, what are you really sort of enjoying most about what you're doing?
I'd say there's two factors. First is that I really enjoy the challenge of trying to figure out what's coming, what's going to happen next. And that applies to both individual stocks. Each one is its own puzzle. And with junior mining, that puzzle includes geology, exploration techniques, capital markets. Are they going to have the money? Capital structure, what's happening with warrants and all these kind of. So there's a puzzle within each stock that doesn't have a specific answer because there's also a bunch of luck involved in
Mm.
exploration. There's a puzzle within each stock, and then that puzzle fits within this bigger picture. I said there's no point buying well, I shouldn't say there's no point. There's less likelihood of success buying a stock or a copper stock or a nickel stock unless that metal is rising. The price for that metal is rising
Mm.
and there's some attention going. If the stock that you're buying makes a really standout discovery, that can do very well in the market, regardless of what's going on with the metal price. But in general, you want a buoyant market to go along with it. So trying to figure out each stock, but then also trying to figure out what's happening. Like what and these are big, big pictures. These are like, you know, interest rates and liquidity flows in China. These are, infrastructure announcements related to politics in America. These are, big picture things. What's going on in the broad stock markets? What is driving investor fund flows right now? What are the forces that are likely to change that? Because one of the metals go on these big cycles for two reasons. They go on them because of supply demand. And so when there is insufficient supply to meet demand, but then coupled with that, when that happens and the generalist market sees it happening, you get this turn, these eyes turn to our space. And especially when you're looking at, gold or, individual metals, these spaces are pretty darn small, right? Like you can put together the entire gold market and it's smaller than one major oil company. So when investor interest turns to this space, it's like a fire hose trying to feed through a little tiny straw. So like that's why you can get these dramatic share price returns. So it's really important to try and understand when that investor interest might arrive. So trying to figure out the puzzle of the big picture of that investor interest and fund flows and each stock. So that's the first thing I like. And the second thing I like is that there's a lot of investors who are really interested in this space, who see, who understand the kinds of things that I've just been talking about, maybe who have done well in the past, who have seen friends do well in the past, who like the space, but don't have well, maybe not 24 hours a day, but don't
Mm.
have all the hours in the day that you need to figure out all of those puzzles. So I love being able to help retail investors with that. And because you need the knowledge, you need the network, and you need the time to figure out the stocks and the macro picture. So the reason that I started my letter is because, I mean, I suppose I could just be doing this to invest myself. But I also am a journalist. I love communicating. So I really like helping individual investors figure out these puzzles because I can tell that they're interested and that they'd love to have the time to figure it out, but they don't because they have other jobs and
Yeah.
lives. So those are the two things I really like. I've just realized that there's a fingerprint across my camera, so pardon me.
No
It
stress.
might look better now. Like, oh, a blur. A child may have done that. Anyway.
Who would have thought? The natures of being in a young family. So, I mean, naturally for you, there's clearly a certain few, or maybe not few, quite a handful of metals that are looking attractive at the moment. And I mean, it goes without saying, you can say gold. I mean, I've spoken about silver. You're looking at uranium. You're looking at lithium. You're looking at rare earths. I mean, there's really no shortage at the moment of conversations about metals, but it's almost important to know that when there's this oversaturation of news, you go, well, is this again one of those hype machines? Has some of the smart money already been made? And there's going to be this accumulation. So, I mean, for you at the moment, going through your research, given this setup that we're hopefully approaching, I mean, it's never a given, or no one can see into the future, but you'd say highly likely. I mean, what are you focusing on in your research, and where are you seeing the potential opportunities emerge? Maybe in the small cap, but more so from the sectors and the commodities.
Yeah, for sure. So I'm going to answer that in two parts. I'm going to answer what I see in the next like few months, like the short term, if you
Short
want to
term.
just play the market right now, and then beyond that. So in the very short term, I do think that we are nearing a point where these markets are going to turn. I don't think that's going to happen. I'm going to say this summer. You're on the other side of the world, so it's winter
Mm,
for you. But anyways, this season,
yeah.
um, because it's like turning an oil tanker around in the ocean. It's taking a while for investors to come around to accept the idea, assuming that what I'm about to say is true, but accept the idea that we have likely avoided a recession, a hard landing, the difficulties that all through 2022 were assumed were going to come out of this rate hike cycle. Like really in 2022, everybody assumed the central banks were going to tighten us into a recession. There was just no other way of managing this rampant inflation. As it turns out, especially in the last when we've seen June's inflation numbers, at least in America, which is the driving force that I talk about a lot. It does seem like the Fed might just have done it. Like it seems like
Mm,
we might have avoided a recession. We might be in this soft landing, and the reason that that really matters is because that means that we can look ahead. We don't have to deal with the recession, and we can just carry on with growth. Once investors get their heads around that idea. Okay, I don't need to be fearful of a recession anymore. What I need to do is position for economic growth. That's when they start to buy copper. That's when they buy nickel. That's when they buy lithium. That's when they buy uranium. That's when they buy these think commodity. That's when they buy commodities. Commodities are the play when you expect global economic growth. And so that's coming, but it takes a long time for that mentality to shift because that recession fear was really ingrained in us. And so I think that that's happening. There's still debate. We still don't know. Things could potentially still turn down, but each month I'm seeing better and better or more and more consistent data that's helping me believe that that's what we've done. So I do think that I am still buying stocks that give me give me exposure to nickel, silver, copper, and uranium, because those are the four that stand out to me as markets of scale that have significant potential once we get into this growth cycle because they are structurally undersupplied. So I'm positioning in those for sure. I just don't think that's going to happen in the next few months. So in the next few months, what I'm buying are, and maybe your investors are bored of hearing this, but are lithium stocks.
yeah.
And yeah, a bunch of that has already happened for sure. But the setup with lithium, if you'll just give me a moment, is 20 years ago, we used it for ceramics. Like it was a teeny tiny market that we used for almost nothing. Now we need it for every electric vehicle on the road, amongst a million other things, every, earbud and every whatever it is, right? And so this is a market that has grown so rapidly that it's hard to wrap your head around the increase in demand. So again, 15 years ago, 10 years ago, even 5 years ago, we'd hardly looked around the world to find good lithium deposits, which is a very, very different setup from those other metals that I just mentioned. We've spent decades looking for good gold deposits, copper deposits, silver deposits. That's been the meat, the heart of,
Mm.
growth, the metals and growth sector. But we hadn't done it with lithium. And so it's like a brand new thing, like looking around the world. Whoa, oh wait, there's these pegmatites with spodumene in them poking up out of the ground that you can see on like satellite imagery when you look around Canada. Oh, that's interesting. So it's a brand new market, which is exciting, because like for lithium exploration in Canada, there's one stock in particular called Patriot Battery Metals that went through the moon. It went from 50 cents to
Mm.
$15 in the last few years because it made this discovery. Is their Corvette discovery the only lithium bearing pegmatite in Canada? Very unlikely that that's the case. There
Mm.
are going to be more lithium discoveries in Canada. And I think because this market is still so new, I think that those discoveries will still this summer, this season, generate dramatic response because people are still very excited. There's a acute awareness that we need to fill the lithium project pipeline. Even a year from now, I think there will have been enough discoveries that people will start to wrap their head around. Oh, you know what? There's actually a lot of lithium around. No, we haven't filled the supply pipeline. It takes a long time to delineate a deposit, permit a mine, build a mine, start producing lithium. But sort of that acute reaction, that excitement around new discoveries, I think will have ebbed even just in the next 6 to 12 months. I think that will come down. But I think we are still in a moment where new lithium discoveries are going to generate exciting response. And since I don't expect that kind of interest in the other metals, that's why I'm sort of playing lithium this season, in particular, because I'm in Canada where there is this Canadian lithium exploration craze. So I'm sort of in the heart of it. I can see the opportunities. So I'm doing that for the short term, but for the medium term, I'm definitely positioning in those other metals. I realize I
Mm.
didn't talk about gold, but we can talk about gold as well if you'd like.
No, no, that's fine. No, I wanted to flash back there to your point about, again, avoiding this recession fear, because it's almost been, yeah, as you pointed to, like an expectation, the fear in 2022 with the rate hikes, that we've been approaching this impending recession, and there's been this hesitancy, but defying a lot of it, the price movements arranging all sectors has been vastly positive, and it's sort of counterintuitive to what a lot of people and a lot of economists have predicted. And I want to know your thoughts on potentially why there's been this resilience in the US sector or the US markets, because that in a way does drive the sentiment for other markets to follow in a weird way. And it's just been well, if you've been sitting on the sidelines for the past 6 months, you've probably missed out on quite a bit of returns in all seriousness. So what are your thoughts on that?
It's a really big, interesting question. So I think post great financial crisis, we moved into a slightly we moved the macroeconomic setup shifted because central banks made it their job to support the stock market. And that was necessary in the wake of that great financial crisis and then again in the wake of the COVID crash. But it has shifted notably it's added a significant new influence on stock markets, which is that, the central banks, or not the central banks, yeah, sorry, the central banks, the Fed, will not really allow dramatic or will step into support when stock markets start to turn down. I'm not going to say that the Fed would have stepped in to prevent a recession.
Mm.
They needed to do their first job, which is fighting inflation, and inflation had absolutely got to a level that needed to be fought. But they, at the same time, are very aware of the other impacts of their actions. So if you look back just recently at sort of the bank crises, mini bank crises that we had in March, where a couple banks failed in America, that is that's sort of micro capture of what's going on here. So the Fed is in a tightening cycle. They're an unprecedented rate hike cycle, but because of that mini bank cycle, they found a way to provide liquidity to support banks in particular, so that they wouldn't fail in the wake of that. I'm not judging what if they should or shouldn't do this, but they made it easier for banks to get money, which is loosening, while they were in the midst of a dramatic tightening cycle. So the Fed has become, I don't want to say nimble, their tools are still
Mm.
rather blunt, but they have become more involved. They have expanded their toolkit dramatically. and they've become more involved. And so even though the reaction to the COVID crisis was dramatic, and lots would still call it blunt. It did come from the experience of the great financial crisis, where who did the central banks primarily help? Well, they primarily helped big business, right? They primarily helped, like major banks, financial institutions. In the COVID crisis, who did they help? Well, they generally helped small businesses and individuals. And that's made a huge difference. And so credit to the central banks for having taken that learning to heart, because that difference means, I think that has been the difference. I think it means that people have not fared terribly in the wake. In fact, quite a few people have fared quite well.
Mm.
I mean, emotionally, that's a different thing, but financially, in the wake of COVID, people have fared quite well. And that really matters because the US market is a consumer driven market. And so if you can have people continue to buy, people had confidence that they would have jobs, they had reasonable or even good amounts of money in the bank, and those two things are incredibly important in the U.S. economy in particular. And so they kept buying, which kept returns on, which kept earnings for a bunch of the most important stocks going. Um, and then you had these extra things going on in addition, like healthcare having its own opportunities, like big tech having its incredible opportunities in the wake of COVID. You had all these other things that came into the stock market and were clear gainers. And so it's piled on, and it has meant that the US economy has come through this with far more resiliency than ever would have been expected based on historical precedent. But I just don't think those historical precedents are fully applicable anymore. I just
Yeah.
think that the setup has changed. The role that central banks played, especially in these last 10 years, has been very different than it was previously. And so obviously it still matters. The fact that, the Fed funds rate is now 5% is really significant. That impacts people's mortgage payments. That impacts lots of things. They can still screw everything up, but they didn't. And I think that they are very more aware than people give them credit for. So I do think that there's a fairly good chance at this point, and I started saying this 6 months ago, but I've said it with sort of increasing conviction
Mm.
each month for the last 6 months, which is that I think maybe they did it. I think maybe they got us to this soft landing. Um, and it's funny because a soft landing just means that, oh, we came through. Everything's okay. There will still at some point be a recession because there's always a recession at some point. That's what market
Yeah.
cycles are. But I think right now, that's not what's next. So it's surprising to a lot of people. But instead of basing investing moves on what you think is supposed to happen, more and more people are now basing investment moves or starting to base their portfolios on what is actually happening. And what is actually happening is that things look pretty good. And especially if a majority of investors start believing that and acting on that, that will actually help us get there because there's a lot of money still sitting on the sidelines from recession wary investors. If that money moves in because they believe it, then that only increases the liquidity that has fueled this market in the first place because liquidity is what the Fed provided. So I think it's happening. It's been for new reasons. It's been surprising, but it nonetheless is. And so I think that's the reality that we have to wrap our heads around.
I think that's fantastic. It's a beautiful description of what has happened because, yeah, it defies a lot of what historical data has proven, and people are very quick and adapt to judging what's previously happened and assuming that it's going to happen again. But as we
Yeah.
saw, the COVID crash and what happened there was again completely out of the playbook. It threw everything out of the door. So naturally, the response has been something we've never quite seen before. But naturally, people are stuck in their ways of how it's always been has to be how it's always going to be, and you've just seen that this unfolding, yeah, this soft landing has not been what people have expected. And again, touch wood, we're still not out of the woods yet, but hopefully that it does start bringing into this next commodities bull cycle, which, as you mentioned before, there's a few that you're looking at. Your four of gold, silver, uranium, and copper. In the longer term, which I'm assuming is your multiple years. And of course, there's going to be fluctuations in prices, undoubtedly. But if I could prioritize the two of them that I'm, I guess, more curious about, gold and uranium. I mean, what are your fascinations with those two in particular? I mean, the gold side first, I guess.
Sure. I mean, they're two fascinating commodities for anybody who spends time in the commodity space. They are two fascinating commodities. Copper is called the PhD of metals because it sort of does what it's supposed to do. But gold and uranium are different. Okay, so gold. Um, Even 6 months ago, when I was more in the camp of, okay, we're probably going to go into a recession, the arguments for gold were different. And that's because gold, there's a few particular drivers of gold, right? Real interest rates. So interest rates minus inflation is one key driver of gold. Gold wants those to be falling negative if possible, but at least falling instead of rising. And then uncertainty, fear, the need to hedge, things like that. Those are the two key, and the US dollar, which is sort of related to rates, but also the US dollar is a very important driver of gold. Okay. So those are the three things. I think we through 2022, the big thing was inflation. Oh, it's going up, it's going up, rates are going up. So real rates were just doing what they were doing. They were not very exciting. They were not helping gold. Um, and if anything, interest rates were rising faster than inflation by the time we got later into 2022 and certainly in 2023. So real interest rates have been going up. What's really interesting about gold is how well it has done despite that, right? Gold is trading near record levels. And
Mm.
if anybody had told me that we would have a fairly lackluster gold equities space while gold trades at $1,900 and like 1960 a few years ago, I would have been like, you're kidding me. Come on, this is what we need. But it has still been lackluster. And so, okay, what's going on here? I think a few things are happening. Gold had a lot of uncertainty associated drivers in the last few years. So, like when COVID happened, gold rared, just came out of COVID like a shot, right? And
Yeah.
that classic example, right? That's the classic example of gold being a hedge, gold rising first and fastest out of recessions. And so, gold did that. We've had a couple reminders that gold does precisely that in the last few years. It did the same out of the great financial crisis. It raced out of the great financial crisis. And so there was a lot of buying of gold, a good amount of buying in gold in 2022 because people were positioning for precisely that. And so I think that kept gold very buoyant through 2022 and into 2023. Then the tanker started turning and we started saying, what if there isn't a recession? What's gold going to do if there isn't a recession? And what's been playing into gold in that question is geopolitics. And usually, when you say geopolitics with gold, people think of discrete crises, right? Like some, war, things like that. I'm
Terrorist
not talking
attacks,
about
something. Mm.
yeah, I'm not talking about a discrete crisis that impacts the price of gold for a short period of time. I'm talking about de-dollarization and de-globalization. And now I don't want to say that these things are happening tomorrow and everyone needs to buy gold. That's not my position. What I am saying is that politicians and central bankers around the world realize that this is happening very slowly, but undeniably. And so central banks are buying gold hand over fist. Central bank purchases of gold are through the roof. Why are they doing that? Because there's a lot of countries in the world. If you look at the which central banks are buying gold, it's gone way up, but there's a whole bunch of them that are not disclosing who they are. So the World Gold Council knows that these are central bank purchases, but they don't know which central bank is doing it, or they know, but they're not allowed to say. That's because there's all kinds of countries that are positioning for a deglobalized, de-dollarized world. And that means that they need to have an alternative to the US dollar. So they're buying boatloads of gold. That has
Mm.
really helped the price of gold. It hasn't helped gold equities because central banks don't buy gold equities. So that's one of the reasons that we've had this disconnect. But so de-dollarization, deglobalization, those have really been just helping gold stay elevated. Going forward, what's going to happen for gold? Well, I don't see a crisis in the next little bit, right? That's one of the reasons that I don't expect gold to perform super well starting tomorrow. I don't think that we're coming up against a recession. I don't think that we're coming up against a crisis. So that's not going to send gold on its shooting up first and fastest out of other things movement. What I do think is going to happen, though, is that we're going to get a broad metals bull market, and gold likes to participate in those. Even though its drivers are different, it still participates in metals bull markets. And it participates in them because they usually happen when real interest rates are falling, and when interest has turned to commodities as a whole. And often the dollar is also weak. Those things really help gold. Those are just basic helps for gold. So I think the gold opportunity is really alongside other metals for the next little while. I don't put it in its own category, which is interesting because usually it is in its own category. But right now, I actually think it's going to go along for the ride, helped quite a bit by de-dollarization and deglobalization and the buying of physical that is happening alongside that. And so hopefully at some point that will tip investors. The strength of the gold price on its own will tip investor interest over into the equities as well.
Yeah, because where gold, at least the spot price, is holding at the moment has been, yeah, quite extraordinary. It's been holding at a level that a lot have been like, well, given what gold usually does, falls away and it's just been bounding around. But it's holding a very strong level, which indicates, well, something underlying is happening. But as you said, like not everyone's got the time to investigate it and understand really what is happening behind the scenes that's dictating this price. Because yeah, even me being a little bit naive with gold, it's just like one of those really frustrating commodities where it's like, it hasn't flowed into the equities. And I think a lot of investors have noticed that. And that's a pretty, commanding point as to why. But switching across now to uranium, which is a whole different kettle of fish. I mean, I'm a big bull fan. I've been for quite a while. I think just the way that we're going towards addressing this energy potential crisis, they like to throw that out there, but finding substitutes for energy, nuclear has got to be in the conversation, and therefore a subproduct is uranium. And it's another very interesting, volatile place to be in. But what are your thoughts on the uranium and what's happening there to, again, get investors excited about getting into that commodity?
So I could talk about uranium for an hour. I
Mm.
will try and talk about it for just a few moments instead. You pinned it when you said that the energy needs conversation has to involve nuclear. And what's been really uranophiles have said that for years. What's changed lately is that they are not alone in saying it. So now there's politicians of all stripes around the world who are saying we need nuclear power. It is one of the answers. And that sentiment shift has been palpable. And that matters so much when you're talking about uranium and nuclear power. We are really in a moment that is very different, which is that there is becoming to be there's becoming to be, that's not a phrase. Anyways, there is much wider spread public support for nuclear power is absolutely developing, and it's being driven by politicians who realize that we need baseload green power and that nuclear is the answer to that. So that's a dramatic shift. The other important thing that's happening is the advent of small modular reactors. So forever until now, the only buyers of uranium have been massive utilities that run absolutely massive nuclear power plants, right? And now we're starting to build these small modular reactors, which are the new face of nuclear. And they're the new face of nuclear because the people who buy uranium for those small modular reactors care where the uranium comes from. Utilities
Mm.
don't care where the uranium comes from. They'll buy it from Kazakhstan. They'll buy it from wherever, because all they care about is getting the lowest price uranium because they're just massive power companies. Small modular reactors. I mean, the leaders in the small modular reactor field, at least leading faces, are Bill Gates, who is standing up here and saying we need domestic uranium. So it's a dramatic shift in this. So the US market for uranium has been very consistent. Where they get it from has shifted over the years, but the amount that they've needed has been very consistent for years and years and years, decades. Small modular reactors are set to change that dramatically. So instead of the nuclear story being for uranium being that uranium growth demand is coming from China, 5 years ago even that's what we said, and it was true. We still have that. Uranium demand growth is absolutely still coming from China. They're still building tons of reactors, but now we also have dramatic growth happening in the United States and similar countries like that because of small modular reactors. And so demand growth is really happening, and it is changing the face of who's buying uranium because it's now starting to be people who care to some extent about where that uranium comes from. Of course, that plays into the whole geopolitics and a bunch of our uranium coming from people caring about whether the uranium is coming from friendly or unfriendly places. The other big thing that's happened on the uranium demand front is that we've had the establishment of a whole army of sequesterers, right? So these are the financial institutions that have decided that they want to own uranium because uranium will be worth more in X number of years. And so the Sprott Physical Uranium Trust, is the standout in that category. They've spent billions of dollars buying uranium already. They will continue to do so. That's been on pause for the last little while because investors haven't been interested in uranium, which means they haven't been buying into the fund, which means the fund isn't allowed to buy new uranium. There's a bunch of details there that I could explain, but I won't
Yeah.
dive the weeds in that depth right now. But these sequesterers have also taken a bunch of supply off of the market. increasing supply and removing supply from the market, or increasing demand and removing supply from the market matter to any commodity. They matter in particular for uranium because looking back to 2016, we were dramatically oversupplied with uranium, but the players of the market decided to turn that boat around themselves by reducing output, sequestering some supplies, shuttering some mines. They said, we can't keep producing uranium into the void. We need to change our market. And that change is now here. We don't have enough uranium. There's funds that are stockpiling the little bit of uranium that there is. Things are getting tight out there. Utilities don't have the contract signed that they need to fill their reactors, which you can't let run dry, over the next decade. Legions of new large reactors are being built, and there's all these small modular reactors being built. There's just a huge amount of demand growing, and supply is shrinking. And the faces who are playing in the game are changing. And I do think that this is going to happen. When I mentioned before about how a lot of commodities markets are quite small, and so when investor interest turns, it can be dramatic, the fire hose into the straw
Mm.
thing. Uranium is the standout example for that, which is the uranium market is minuscule. Like, the number of, publicly listed uranium companies of any sort of scale, is it 100? Like, it's a very small number. You compare that to oil and gas, right? The thousands and thousands and thousands of players, right? So if people decide that there's a bullish oil spectrum or outlook, there's so many companies that they can buy. And they decide that there's a bullish uranium outlook, there's very few companies that they can buy. And that's why uranium has the most dramatic cycles. Spike,
Yeah.
any commodity.
Yeah. Well,
Uh, yeah.
when I was speaking with John Borshoff, the CEO and managing director of Deep Yellow, he was alluding to this as well. Naturally the lack of potential experience in the uranium sector and understanding how to actually operate and develop mines, but the change in tone, you said from politicians. I flash back to Japan saying they're going to be restarting their nuclear fleet. China has some incredible objectives to meet in regards to building new nuclear reactors. And when you look at how much they're going to require, it's outstripping almost everything. And I mean, there's quite a bit of it around, but naturally you've got the US as well. I noticed Australia, there's been more conversations about it. There is this real turning point. And it's quite exciting to see because, yeah, naturally it's got to play a role in where it's going. But I mean, naturally, you've got this wealth of experience and knowledge. I can just hear it in the way that you're talking, and this feeds into the Maven letter. And I guess, how would you describe what that is? And for listeners that want to learn more about that, naturally, I mean, what are you offering for subscribers of that? And yeah, how can they get involved in it?
Thank you for asking. um, so resourcemaven.ca is my website. So you can find me there. The Maven letter is a weekly newsletter about two things: what's going on in the metals and mining space, so macroeconomics or fund flows, or interesting things that are happening in copper or lithium. So I write about what's going on in the space that I'm seeing, and I write about what stocks I am buying or selling. And I make that statement very clear because there's a wide range of newsletter styles out there. And there's a good number of them that newsletter writers who work with companies. So that means companies pay them to create
Mm.
content. And that content is naturally going to be supportive of the company. I don't take money from companies. I write about what stocks I'm buying and selling in my portfolio. And the reason is so that my readers who are subscribers, that's the business model, people pay to read what I write, they can um, just follow those moves if they are the kind of investor that I described at the beginning, which is a interested retail investor who doesn't have the time to do all of the research on his or her own. I try to fill that gap because it's a very big gap. It's a lot of research that's needed. So I write about what I'm buying and selling. The Maven letter is largely fairly speculative stocks, right? So I do a lot of exploration or mine development end of the spectrum. So it's high risk stuff, but there's high reward potential in that as well. For those who are interested in the energy transition as a whole and are not interested in high risk stocks, I also write the Evergreen Investing newsletter, which is about the inputs and innovations that are needed for the green transition to happen. So metals and energy are certainly part of that. So are carbon credits, things like that. So that's a low risk investment newsletter that is about these things that we need to make the energy transition happen. So that's the low risk side. the high risk side I write about in the Maven letter, and it's all about what stocks I'm buying and selling.
It's great because we touched on before. I operate primarily in the Australian Stock Exchange, and you're focusing more on the US and Canada. And you can't be up 24 hours of the day. Time poor is definitely something that a lot of people have going on, and
Yeah,
it's a good opportunity to actually stay on top of it because, yeah, drilling down on, as you said at the beginning, the geology, the team involved, where they are, what permits they got in place, it can take hours and there's so many opportunities, and that can be a distinguishing factor in potentially missing the boat, in layman terms. So
absolutely.
I think it's a great resource. And yeah, I wanted to thank you for coming and speaking on the show. Naturally, I'm looking forward to speaking again in the future to see if the predictions or the things we've talked about here have come to fruition. Oh, there we go. Some company on the podcast.
Okay.
Um, but yeah, thank you so much, Gwen, for speaking with me today.
Thank you so much for having me. It's been a lovely conversation. And yeah, I do hope we chat again soon and or in a little while, and we can touch base on all of these hypotheses.
Thanks for listening to the Market Bull podcast. If you enjoyed it, please make sure to like and subscribe. You can follow the Market Bull on our socials at Twitter and LinkedIn by searching The Market Bull. You can also subscribe to our newsletter on the website by visiting www.themarketbull.com.au.